And here we are again in one of the biggest shifts that is happening in real estate in Australia. The shift from residential to commercial using almost the same strategies that you would use in residential, however, better, faster, safer, and far more cash flow. The focus on property investing is shifting from the traditional residential property investment example, standard house, cottage, apartment, to a well-structured commercial property. However, heed caution, investors. Investors must avoid the trap of buying the incorrect commercial property. So in other words, a property in the incorrect area with the wrong lease on it and not knowing anything about the area. So the wrong asset might sit empty for 12 months. It might be at the end of the lease. It might be a lease back, which means that the tenant has put their own lease on the property and then they're exiting the property, leaving you high and dry with an empty property. If your goal is to purchase a flip property, it can be done in commercial, far better, far safer, and with rigorous controls. You can take a property from negative geared right up to cash flow with positive as a positive asset, with uplift value, with all the positivities that you get out of a commercial property. So how do you do this? Here is a 3-step strategy. Rinse and repeat. Okay, so let's say you buy a property that's undervalued. Purchase an undervalued commercial property if you can find one, or even a residential property that can be converted into a commercial property and earn the tax benefits. You have to ensure that it is already producing cash flow or at least breaking even with your outgoings from day one. All right, that would be strategy 1. Next would be, let's have a look at uplift value. Refurbish a property, secure a new lease. So in other words, if you find a property that's in a great area that's vacant and you know that you can get it tenanted and you might need to do a little bit of a refurbish, do a refurbish, secure a new lease, secure a new tenant, bring in the new tenants, and then you claim all the tax benefits on these improvements, which drastically drives up the value of the asset. All right. Make sure that you have your valuations done before and your valuations done afterwards. Make sure that you do all your homework right and you know exactly what you're doing, because this strategy could hurt you if you're dealing with the wrong people and the wrong property. Next, number 3, refinance and reinvest. So find a great property, do the uplift. Then what you do is get a reevaluation on the newly uplifted property, pull out all the equity, rinse and repeat. And then what you do with the equity is you go and you do this again. You use the capital to go and find another property and do it all over again. Give you a little example. We had a client that bought a property for $1 million. It was at the end of the lease. The tenant moved out, beautiful property, needed a little bit of work, a little bit of shining up here and there. Stood vacant for about 3 to 6 months until they found another tenant. So there are holding costs involved in that. Tenant came in. The beauty is the outgoing tenant was paying $63,000 per annum. New tenant is paying $70,000, triple net lease, including all outgoings. So triple net lease means that the tenant pays all outgoings and you're getting $70,000 net out of that property. Your rental is $70,000 net, which means no expenses. Tenant pays for everything. So huge uplift on that property, and they did a reevaluation of it. They pulled out $700,000 of equity and could go and do it again. So that is a beautiful example of how you can do this. The bottom line is, while you might temporarily have to negatively gear the property, so in other words, holding costs while it's vacant or while you're busy doing initial phases of building uplift, it's well worth it. The critical method allows you to scale rapidly. So if you're looking to scale, this is the way to do it. It is slightly higher risk, and if you're prepared to wear it, you can do this fast. By focusing on a commercial property, a good asset, you can achieve the same wealth building results in 3 years, 5 years, thereabouts. You would typically take up to 10, from 10 to 15 years if you're trying to do this in residential property. And that there, people, is the huge difference between residential and commercial. If you want to know more, click on the link below and join us on the next podcast. Give us a rating. If you've enjoyed this podcast, share this review with your friends and give us a 5-star rating. It all helps, and we really, really appreciate you being here and helping us grow the good news. Thank you.